This video explores the UK property market. What to expect given the recent increases in interest rates? Has the Bank of England stopped rate increases, or is it just a short-term pause? Put differently, to buy or not to buy? This is the question. Regular viewers will know no data, no video. So let's get some data on UK house prices. All the links are in the description if you want to explore it yourself. I suggest the nationwide house price data. So we go here to the UK data series and then look at UK house prices since 1952. In this video, I will focus on the country level. Of course, there is quite substantial cross-country variation, but this requires more advanced methods to study. Let's look at UK house prices since 1952, get our data in Excel, and have a quick look at the price trend. So here is the Excel file, and as you can see, we have quarterly data that seem to start in the second quarter of 1953. I suggest focusing on the longest time series available and ignoring the differences between different types of houses. So let's look at a line chart, just taking the all house price index. So we see this massive increase of house prices over time, and many people of course are then arguing that house prices are overvalued, but of course that depends on income levels, which we explore later. At the moment we do not consider inflation as well, so we should do both. So we will look at GDP, so gross domestic product. We will do this per capita, and also as a measure for the total size of the economy, we take GDP at current market prices. So it's all in nominal values. So it includes inflation as well. To get the data, we head to the ONS, and we obtain data for the gross domestic product per head. CVM stands for chained volume measures, which we might cover in a future video. It's actually quite interesting. In short, this is an adjustment for price changes, but I don't want to go into details at this point. So again, we can download all the data in Excel files and have a little look at the structure. Yeah, so this is now my data on the gross domestic product per head. And you see we start here with annual data, and further below is quarterly data. And when you add up the quarterly figures, you obtain the annual figures. So there is a direct relationship, as you would expect. In my Udemy course, Getting Started with Stata, I discuss various methods to combine data sets. In my Udemy course, Getting Started with Stata, I discuss various methods to combine data sets. The link is in the description. As we have a very small data set, in this particular case, you can do it manually in Excel. You simply take the time series you want, you copy paste them into maybe a new file and save this file as a final data set. So in here we combined the house price data, GDP data, so that's for the whole economy, and GDP per capita. Quarterly data are not always easy to work with because there is seasonality. This needs to be considered. I covered this issue in my Applied Time Series course. Again, you find the link in the description. Before we get back to the data, let's look at a few descriptive results. I always start by plotting my data to spot patterns that might benefit from further analysis. This figure shows house prices and GDP per capita. All figures are nominal, that is, in current market prices. Both time series seem to share common stochastic trend, so they kind of co-move. This can be explored in more advanced time series analysis, such as co-integration analysis. It is quite common to use ratios such as price-income ratios to discuss the over- or undervaluation of a property market. However, taking someone's income does not capture changes in household composition and work patterns. So in summary, we need to consider additional factors for a more detailed analysis. But still, looking at some line charts is a good start. So based on the patterns we observe, there might be a long-term equilibrium linking household income to house prices. This is plausible as income determines affordability and also rents. Next, we can look at the size of the economy. This also captures changes in population size. A quite similar pattern emerges. We certainly observe exponential growth in both time series. In this case, it's quite useful to use log scales. In the case of log scales, a straight line would suggest long-term growth at a constant rate. So it's easier to see growth patterns using log scales. I capture this in an additional video focused on exponential growth and log scales. So here we look at the log GDP per capita. So we see a period of quite high growth followed by a slower growth period roughly from the 1990s. Now there are many reasons for that, including slower than expected productivity growth in the UK. But I'll leave this for a future video to explore further. Now, there are periods of over and undervaluation of the property market. House prices tend to move in waves. In summary, prices tend to develop in line with economic growth. Also, we observe that property is a good inflation hedge. Certainly better than investing in gold, which I covered in another video. House price growth tends to exhibit serial correlation, so we have a positive relationship between past increases in house prices and future increases in house prices. Now these patterns can be studied using ARIMA models, for instance, which I cover in detail in my Applied Time Series course. In general, this is the time to buy, if you can afford it. And that is the catch. Mortgages are much more expensive. However, in the long term, the fundamentals remain solid, suggesting a return to higher growth rates. Now let's move to Stata to have a more careful look at the data. So in this case, I simply copy-pasted the data from my Excel file into Stata using the data editor. Now this is quite fine for a small data set. If it's more complex, there are better options which I discuss in other videos. Now in this particular case, the time dimension is read as a string, so you see this as indicated by a red color. So to convert this string into a date variable, we have to extract parts of the string. And as you can see, the first 4 refer to the year and the last 2 refer to the quarter. I have done all of this work in my Stata do file, which you can obtain from GitHub. The link is in the description. So you can just test it yourself, playing around with it. Please leave a comment if you have any questions or suggestions. Check out my playlists on data analysis, and please spread the joy of data analysis by liking and sharing this video. This is the way.